Well, as we're reaching into new high territory, once again this year, we had CPI data come out and the market loved it. Today's video is just a friendly reminder of the bigger picture. We're also going to dive more intricate into the conditions of the market because the moment that these conditions change, it's really going to open up the possibility to see some volatility, and we really need to respect it when that day comes. So I'm going to show you exactly what to look for on today's Stock Market Brief Show, which is brought to you by you, the subscribers, the people that subscribe to the channel, my patrons that pay $9 a month or annually to get some additional data. Thank you for supporting the channel, and my family, Interactive Brokers, my partner as well. If you haven't checked them out, make sure to click that link to check them out. And then also, when you click the link, take a look at their Interactive Brokers campus because they offer up a bunch of tools and resources, news feeds, etc. I mean, the list goes on and on with this award-winning brokerage firm. They got trader insights, webinars, podcasts, you name it. Let's get into today's show. All right, everybody. Yes, we got inflation data out today. It accelerated to 2.7, but that was as expected. Now, the United States inflation rate has been upticking, but if you take a look at core inflation rate, it kind of flatlined over here. Now, that's not necessarily what's important. What's important, what the market does. And how do we interpret that? Well, we can take a look at what the federal funds rate probabilities are looking like. And if we take a look at and we compare for December 18th, which is coming up here, what did the probabilities start to do? They started to increase as far as getting a 25 basis point rate cut. And as keeping them where they were, the probabilities of that has started to level out to near zero. So the market's going to get what the market wants, most likely, which is a 25 basis point cut this next meeting, which is December 18th, just next week. And the market rallied on that news. But not all the markets, right? The Dow Jones Industrial Average managed to fall flat on its face today, down ever so slightly, but we did have consumer discretionary ripping, communication services, and tech, the big mega names leading the way, while down there at the bottom of the list, you got utilities, consumer staples, and healthcare, which are all really risk off type sectors. So you see them at the bottom of the list. Today was a risk on day. Now, why was Dow Jones flat? Well, if you take a look here at the Dow Jones heat map, UNH is lit up bright red, and UNH fell 6% almost today, and it's been down 15% in the last week of trading. If you take a look back at the heat map here, Apple actually fell flat too. And if you look at Apple, well, I mean, the thing's been on a monster run and it got outside of its expected move. It came back in, created somewhat of a shooting star candle. So I wouldn't be surprised if this takes a little bit of a breather in the near future, consolidates, digests. That is completely normal. Nvidia is another one that happened to be up on the day, but in recent trade, it's been rather flat to pulling in. Yesterday's video, we talked how it was outside of the weekly expected move. And we also showed the semiconductors ETF, how that closed at the lower weekly expected move. And we talked about how we wouldn't be surprised if semiconductors caught a bid because it's a discounting mechanism. The market discounted CPI report, and then it happened to be one of the top performing sectors. If we take a look at what the Qs did, the Qs from the lower end of the weekly expected move yesterday, they liked the move. The mega cap names moved into the month to date expected move. Now, the month to date, this is the upper level. It's only December 11th right now, and we're already breaching into the expected move that the options market priced in. We're still below the lower weekly expected move, but we're well within the week, so nothing is unexpected here from a week-to-date basis in the Qs. Everything's happening exactly how the market's priced it in. We still got 2 trading days left. If I look back at this old pattern that we talked about way back when over here, we talked about its measured move, and a measured move would still bring us up to and around that 550 in the Qs. So if we get some more bullish momentum in the magnificent 7 stocks in the Qs, I would expect to see 550 as the potential price target for an area for market to pull back, potentially digest, and see kind of what happens if we can get up into those areas. The SPY, way back when, we talked about with this cup with handle pattern, and a measured move would take us up to and around 620. And that happens to be the quarter to date right slightly above the quarter to date expected move, and we haven't reached that yet. The upper monthly expected move, which is for December, is up here too. And as far as the week goes, we're rather unchanged. The market price in about a $6.32 expected move. CPI's out of the way. The market's flat. Tomorrow we got some more data coming out too with a wide open risk range. And we haven't yet tagged either side yet, but we did get, within pennies, it felt like, or a dollar or so. If we take a look at the IWM has been flagging out. It's just been consolidating. And way back when in October, right? Going into October, we looked at the quarter to date expected moves. So we drew this level on the screen back then. And take a look. Within not even the full quarter, the market moved up into its quarterly expected move, and it started back, kind of pulling back in ever so slightly. The weekly expected move is $5. We haven't tagged the lower and or the upper, and you can see for the month to date, it's still a wide open range. Now, I'm interested in IWM if we start to see a breakout. Now, I don't have the month-to-date anchored volume weighted average price right now, but I can tell you kind of where it's at. So in December, where the month started, if we anchor a volume weighted average price, it started it was right about here when the price action started getting rejected from it. So I'd like to see this start to be breaking through and start to head higher in the near future, but I want some confirmation on the smaller time frames, like we'll talk about in the trend changer section in market conditions. The 10-year yield was up slightly on the trading session here too as well. As we've been talking about, a stronger yield looked like it was possible as it was kind of wedging down here in prior trading sessions. And that brought down the TLT. So the bond market came off pretty hard, 95 basis points. So perhaps this is why the Dow Jones fell flat on its face. And you would think that potentially more names could fall flat on their face given the context of the bond market coming off so hard. But that wasn't the case today because order flow was rather bullish in these Magnificent Seven. Now, speaking of this, why is the 10-year yield up? Well, perhaps it's because oil has been giving us some insight. Oil, right, a big commodity here, typically leads the 10-year yield that we've seen in the past, right? The oil right here, the black line started going down. Shortly thereafter, the 10-year yield started falling. Take a look over here. It started rising back up again. We saw a spike in the 10-year yield there, right over here, right? Oil started to find a bottom over there. And then guess what? The 10-year yield started to follow there shortly thereafter. It wasn't until recently where the 10-year yield started rising and started diverging from oil, but I feel like this correlation is going to eventually come back into sync as we're starting to see that happen in the near term. So if oil wants to continue higher, we'll take a look at the oil chart. If oil wants to break out of this compression pattern that's kind of forming right here and start moving into more of a bullish trend, well, that could signal that rates are going to remain rather elevated, potentially even a little bit higher. And that could potentially be good for various small cap stocks. It could be good for potentially various energy names too as well. Gold, on the other hand, started seeing an update, some follow through these last 3 trading sessions. This is coming on the back of also a rising dollar. Typically, when the dollar rises, you have a negative correlation, but in recent trade, that has just not been the case here either. We talked about a potential for a rising dollar, and we're starting to see that here. Remember, this is exactly what happened in 2016 with Trump, right? The dollar typically finds seasonal weakness in October, November. That's normal. But if you go back to 2016, when he goes elected, it rallied into pretty much this day till December 5th, where it pulled back. Then it rallied into 2017 at the time. And then from there, we put in a series of lower highs and lower lows. Not to say that that's going to be the exact same situation here, obviously, but it's been holding pretty spot on as the days kind of move closer to year end. Now, as we've showed this chart multiple times here too, we watched these intermarket assets, the dollar, the 10-year yield, they both rise, and S&P 500 rose today, but it's kind of flatlining. So if we do get more movement here, just be aware of that. Now, right, I wanted to do a friendly reminder, right? A friendly reminder of the bigger picture of charts. So let's get into that and exactly what I mean, because we covered a lot right there. Clearly, things are bullish. Things look like they can have more room. It's end of the year. We can get end of year markup, end of quarter markup, Santa Claus rally. So fighting the tape and fighting the flow, it's not a good thing to do. Getting all bared up in a bullish trend, like as long as your position sizing makes sense for you, but you're not damaging, you're still preserving and protecting all your capital, that is what you want to have happen. Now, the conditions of the market when they change, this is going to really, really be important as we're kind of losing oxygen up at these higher levels as things get very stretched out. You got to pay attention to these conditions when they change and respect them when they do, because if you don't and you try to buy the dip and it keeps dipping and it keeps dipping, that's when things really can blow things up fast, and you just don't want that to happen. Not to say that that's going to happen. Like I'm not calling out for this. I know it's going to look like it, but you got to respect it, right? You got to respect the history, what has happened in the past. Now, what is this chart? There's a couple of charts here, right? So we have the S&P 500 over here, we have the yield curve here, and then we have the federal funds rate. Now, what I'm pointing out here, dating back to the dot-com era, what do you notice? When you get a yield curve inversion, right, the 10-year, 3-month, the Fed staple, right, when you get it inverted, and this is coming after the Fed increased rates, but then they started cutting rates. And what are we doing now? We're pricing in more rate cuts. Exactly, right? And when we started cutting rates, boom, the yield curve began uninverting and steepening. And what happened to the markets both in 2008 to 2009? Boom, the financial crisis. What happened in 2000 to 2001 after the big run-ups? Boom, the dot-com bubble. Now, both of these times, I mean, right, if you were around, if you were trading it, chances are you probably weren't worried up in these levels. And if you were, maybe if you were very interested, maybe people were saying the same thing here. Well, this time is different. The yield curve is inverting. It's uninverting. See, we're at all-time highs. Okay, but I want to point out this. We had the deepest inversion. We're starting to steepen. We're almost uninverted here. And I will say that the 3-month yield curve, or the 3-month U.S. Treasury yield, that follows, obviously, federal funds rate very closely. And each of these times, right, look at, we're at new highs. It's starting to uninvert. Oh, when we were inverted over here, what were we doing? Oh, we were at new highs. Oh, what about over here? Oh, we were actually at new all-time highs. Oh, what about, we were actually at new all-time highs. So the bullish euphoria has been there, and it has always been. So how do you catch a potential larger market turnaround, right? So not to say that a crash is going to happen or an explosive move or whatever the case is, but we got to look at those conditions of the market, because when they begin to change, we're coming into the territory where the importance meter, right, is really starting to say, hey, this is getting very, very important. It's not going to be easy if these conditions really begin to change on us. Now, if we take a look at the same exact chart, but look at the 10-year, 2-year yield curve, this one has uninverted already, and it's beginning to steepen, and it'll steepen more as time moves forward and we start to get some more cuts. This is very similar to happen here and similar to happen here, and it's kind of happening as we speak right now. And you can see, right, the Fed cut rates, and it ended up not being the greatest sign for the markets. Now, I found this chart to be very interesting, one that I shared a while ago, and this is looking at the 10-year 3-month, the 20-year 3-month, and then the 30-year 3-month yield curve too as well. And basically up here on this is all those yield curves, right? You have the pink line, which is the 3-month, and you can see that this looks exactly like the federal funds rate, right, on the other prior charts. And when it comes off, when they cut rates, it typically goes down. But the only times that I've really seen all of these inverted at once was over here in 2000, right, back over here at the financial crisis. Even right here, it happened, but it happened all together, I think, very, very quickly, right? It was like a little blip over here for a very, very short period of time. And then you look over here and it's like, wow, they were all uninverted. But what I'm starting to pay attention to here is that the 30-year 3-month, it did uninvert. The 20-year 3-month did uninvert. It's this one now that's waiting. And when this happens, if we do start cutting rates significantly more or pausing, what could happen in the markets? What could trigger something in the markets to have the Fed really start to clamp down on these rates and bring them down? Something would potentially have to break, right? Like, for example, right now, why are we cutting rates when inflation creeped up, or it's as expected, right? But the markets are at all-time highs, Bitcoin's at all-time highs, assets. It's a very interesting scenario where we're in this current moment. So what happens if inflation does start to take back up? Are the Fed, are they going to start to increase rates again? Are we going to see stagflation? I think that there's a lot of narratives out here. So we got to just really monitor on a daily basis, weekly basis, monthly basis, kind of what shifts are taking place in these conditions. Now, we're going to look at some indicators, various indicators, volatility, breadth, some just interesting correlations, and then we're going to get into expected moves and market conditions. I want to bring back month, first front month volatility still remains elevated as it stands right now. So once again, it's a time to be cautious up in these levels. It can drive pullbacks, and if we start to see it pull down, then I'd be looking more bullishly down in these levels. But right now, it is rather elevated, and it could stay elevated. It's done that before. It did that actually going into 2022, the bear market. We remained elevated. We pulled down. Okay, boom. We saw a little bit of a bounce band, new highs, and then that got elevated, and then all of a sudden, we started playing within these swing kind of moves here within this same exact back month, first front month, just overbought, oversold type condition. So we're still there. We closed at 24% higher. So back month closed 24% higher than front month. If we take a look at this one, this is a cool correlation. This has to do with the housing market up top and then the S&P 500 down here. Now, the reason why I talk about this is because if you were familiar with back in 2008, the housing index actually topped in like 2005 and then started to trail lower and lower while the S&P 500 went higher and higher. And that divergence really gave us insight in hindsight that that we were leading into some very interesting territory. Now, from a shorter time perspective, I like to look at these divergences too. Now, it's not like they're always going to play out, but take a look here from dating back to 2022 over here, so a couple of years, you can see the S&P 500 push itself higher while housing market kind of remained flat. And that gave us some insight saying, okay, well, the market's going up, the housing market's kind of pulling in. Hey, are we going to see a potential pullback? And in hindsight, yeah, that looks great. Okay, cool, it diverged. Okay, same thing over here, same thing over here. And then on the flip side, it's not always negative. It could be bullish. Look at the housing market, how right here, where in November of 2022, in October, it put in actually a higher low, but yet the stock market put in a lower low. And this bullish divergence here said, hey, perhaps the housing market is signaling something to be bullish. And the markets rallied and they ripped up higher and higher, and they're still higher to this day. In more recent trade, you can see the housing market put in a lower high here while the S&P 500 got pressed higher and higher, and we saw a quick correction in the month of August. And now what do we see? Well, we see the market still pressing higher. No news there. And what is the housing market doing? The housing market closed slightly lower today, and we have matching highs up here. So it's diverging. Does this mean that the S&P 500 has to catch to the downside? No, it doesn't mean that, right? The housing market can catch back up to the upside, but it is just a warning shot looking back through some prior price action. That was kind of interesting. And now while this is taking place, you can look at breadth indicators, right? This is the 20-day moving average, so percent of stocks above the 20-day moving average. Okay, and it's all these different index products. We got NASDAQ, NYSE, NDX, Dow Jones, S&P 100, the 1500, 400, which is mid caps, 600, small caps, 500 right down here. That's the S&P 500. And what do you notice in recent trade? Well, all the breadth, right? As the S&P 500 has been pressing higher, we know this. The percent of stocks above their 20-day moving average in all these products, well, they've been going lower and lower and lower and lower. So there's a lot of stocks not participating in this recent rally. Take a look at the 50-day moving. Did I get this is the 20-day too. I did the 50-day. Must have duplicated the slide right here. Okay, so the S&P 500, the 50-day moving average, and the 200-day percent of stocks above the 200-day moving average. So as the market's pressing higher, what do we see here? Well, it was once 75% of the stocks in the S&P 500 were above the 200-day, but now, as the market's pressing higher, well, only 67% of the stocks are above the 200-day moving average. So there's stocks that are falling, but the market keeps going higher. And this is a cap-weighted index, and that just tells me that the larger market cap names are still performing while the underlying of it is kind of breaking down. And these divergences, they can play out for a while, a very long time. For example, look here in 2024, the market pressed higher and higher, but guess what happened on the percent of stocks above the 50-day? They started going lower and lower. And this is really driven, why? Because of the larger market cap names. But this is where it gets interesting. The market's been pressing higher and higher. We're diverging. So is the larger market cap names going to continue to perform? And I think that that's where it gets interesting here, because if you look at the Qs, right, we had a blowout day today, about a 2 standard, almost 3 standard deviation move here. We already reached into the upper monthly, and for the quarterly expected move is right here. So if we go up a little bit higher to tag the weekly expected move, we would then be above what the market price in for the month, and we'd be where the market price in for the quarter as well. And it's only December 11th in this, as it stands in this current moment. So the Qs, they're getting frothy, they're getting extended, they're going to have to come in, they're going to have to digest at some point, which could stall things out. If we take a look at the NASDAQ summation index, the McClellan summation index, this has been kind of just whipsawing back and forth. I like to apply a parabolic SAR to it because it can act as a potential change in trends. Like, for example, over here, and I used to highlight it for pink, but I haven't for a minute. Boom, we found the bottom, right? Over here, right after a strong move up, what happened? The market went higher, but it started kind of flattening out. And you could see multiple times where it started to cross back up over here, and then it started going back down, and then we saw a little bit of a sell side here, it flipped back up, and so forth. And even right here, you can see it ticked a bunch of times. So right over here, you can see it kind of went sideways, and then we chop, and we're still above the parabolic SAR as it stands. If you look at the NASDAQ McClellan oscillator over here, it's actually starting to lose breath. It's below the zero line as the market's continuing to press higher, which is also a little bit of a concern. As the market presses higher, breadth is weakening, and the summation index also is turning around. You can look at the NYSE summation index, right? This one actually just ticked over today, identifying a potential change in trend. We're below the zero line here too as well. And the market has been kind of coming in ever so slightly from its recent kind of pullback here. Now over here on the, when we had the change in trend, what happened? It was right at about here. And where are we? Well, we went down, we went up, we went up, we went down. We're pretty much unchanged from this level as the summation index weakened quite a bit. If we look at the S&P 500 on the weekly time frame, we shared this chart yesterday, there's still a divergence building here too as well. So the warning signs as the market's pressing higher, right, as we kind of just drift, there are warning signs developing from a bigger picture to a smaller picture. And that comes into why we should really pay close attention to these conditions in the market. Because when they begin to change from a gamma perspective, from a 5-day moving average perspective, if you're not taking your foot off the gas, this is the area where things can really change. Dealers absolutely 100% act differently when they're above the gamma flip line versus when they're below it. When they are below this flip line, which is currently roughly at about 60-30, selling begets selling begets selling, buying begets buying begets buying, and you typically see volatility increase, which we've shared multiple times. When we're above it, you look to buy the dip. So as we pulled down into it the other day, we're above the gamma flip line, and guess what? Well, the dealers bought the dip. Where do we drive to? Back to the call wall, which was 6,100, right? We're not too far off of it. We came into it. It's a big call wall. Boom, we pressed back down. We came into it. It's kind of getting pinned in and around those levels. So I would just be very cautious when we will, once again, when we get back underneath the gamma flip line, because that's a time when the conditions will change. Then you can take a look at the direction of the 5-day moving average on multiple assets. Right now, the SPY is yellow, but we reclaimed it. We're back above it. It's still kind of calculating down. If we stay up here a little bit longer, it's going to turn back to green. So just be aware that we snap back up. Boom, there we go. That's positive cues. Bam, back to green, right? It was yellow right here, just basically saying, hey, price is below it. So be cautionary, but be bullish with caution because it's still trending up. Bam, we started flying up higher. IWM still red and declining as it stands. XBI, DIA, semiconductors, which we talked about yesterday. We said basically if we start to see it bounce because it was rather extended, look to see how it acts around that 5-day moving average. And guess what? It came right into the 5-day moving average today. All right, everybody, that's all I got for you on today's episode. Hope it helps out, give you some insight from both a bigger picture and a very micro picture of these markets. Catch you on the next episode. See you later.